you doing, Langdon?
Hello.
Tyrone's in, Tracy's in. Hi, Tyrone.
Hey,
Tracy.
Hi, I'm here. I have a 2 and a 5-year-old and they're very distracting, so I don't want them to distract everybody in the class.
So you're gonna mute your mic, you mean, for a few minutes?
Yes, and that's why I don't like have it on video, because they will be all over this camera.
Oh, that's okay. We don't mind seeing little ones. Yeah. Not sure how many we're gonna have tonight, with it being the Tuesday night instead of the Monday night. I know, somebody told me, I can't remember, oh, Michelle, that she wasn't gonna be able to be live during the Zoom tonight, but that's all right. She can watch the recording later.
So have you graded that first as homework assignment yet?
No, which one?
Financial analysis
Oh, we
assignment?
were gonna do it as a class. Remember?
Yeah,
We didn't do it though yet.
okay.
Just got through the financial statements last time, so yeah, we can go over that tonight, actually. That's actually.
I guess I thought we were supposed to have it ready to go over in class tonight.
Well, that's
I guess
great
I
if you did.
misunderstood.
Yeah, that's awesome if you did. Yeah, let's take a look here. Class. Okay. Heck is it? Homework assignments. Okay, it's under that. Yeah. We'll have, actually, I'll download it, and I'll download the other one too. So I've got them handy down here. Those. But I thought I could download. There we go. Oh, okay, got it. All right. Minimize it. Minimize us first, minimize that next. And then I'll do the same with the other assignment, which was the forecasting assignment. Download that. And there we go. Okay. So we got both of those done. Let's see, what have we got in the room yet? Just a handful of us so far. Yep. 5 of us. What time is it? 5:34. Well, give everybody else maybe about 1 more minute, and then we'll just go ahead and start. Again, maybe there may be more people who couldn't make it, just didn't know, but we're on recording. So in order to free up space to get this one recorded, I had to delete the first class meeting from recording. Hopefully, oh, I got a couple people in the waiting room. Okay. All right, Laura's there, and I'm not sure who else. There's Laura. And 370-457. Oh, Ishmael, right? Okay. So, yeah. All right. Anybody else still in the waiting room? Just not seeing anybody else in there at this point. Okay. Well, yeah, let's go ahead and start, and then every couple minutes or so here, I'll check and see if anybody else has joined us. But for right now, looks like okay, we got Ishmael, Laura, Trace,
Yeah.
Tyrone, Tom, Langdon, and Nice. So again, I'm sure if you guys notice that somebody has entered the waiting room and is waiting, will you guys just kind of let me know? Because sometimes I get to talking and you know, don't realize that that we got somebody else coming in. So let's do this first. There we go. I want to go to the book. So we finished pretty much everything I had wanted to talk about in chapter 2, because we did talk about the statement of cash flows. Now, one thing I did want to mention briefly, this idea of free cash flows. The definition that your textbook gives right here is a little bit, I mean, there's not one set definition of free cash flows, just so you know. But the most common definition for a statement of cash flows does not subtract dividends. So normally free cash flows, and in the upper level finance courses, what I call free cash flows to equity is just the top two things. It's your cash flows from operating activities, or the cash flows from the normal operations of the business, minus CapEx, capital expenditures on plant and equipment. And that gives you then your free cash flows. Okay. I did want to mention taxes a little bit. Corporate tax rates were 35%. The tax law, which was passed in December of 2017 and effective January 1st, 2018, that changed the corporate tax rate, lowered it from 35% to 21%. Which I think I've mentioned, that is one thing that Trump and the Republican Congress that I do agree with, that they did it, because again, with corporations, you've got the double taxation where the corporation pays corporate tax rates on its earnings, and then any of those earnings paid out in dividends, the individual has to pay personal income taxes on. In fact, I just sold a motel for my mother last year, and we're looking at the motel having the corporation, because it was a C corporation, having to pay a 21% rate. And we got a 1099, or the accountant for my mother got a 1099 for over $1 million dividend distribution. It's like, wait a minute, no. We're not going to pay a 21%, have the corporation pay 21% on the capital gain, and then we turn around and pay 35% of over $1 million on the as dividends. That's just, it's not right. I've been in contact with the accountants. We're getting it and an attorney. We're going to get it all straightened out so it doesn't happen that way. But anyhow, again, at 35, you have double taxation with corporations. At 35%, we did in fact have the highest corporate tax rate in the world. So it probably needed to be lowered. Maybe we'd have been good at 25% instead of 21, but anyhow, is what it is. That's where they moved it to. I'm trying to actually move the page through here. So maybe if I move us, and actually maybe I'll just minimize this for now. I can move through here. Here's a few other things about that rate. It said, okay, so there was a one-time repatriation tax on foreign earnings. See, if a U.S. corporation earns money in another country, they pay U.S. taxes if they bring the money back. If they don't bring the money back, they did not pay U.S. taxes. Well, because of that, there was a lot of money overseas for U.S. corporations that the tax law wanted companies to bring back. So that, okay, any foreign profits that have not been taxed in the U.S. will be subject to an 8% U.S. tax rate. If it's foreign-based cash profits, it's subject to a so in other words, money hasn't been reinvested in plant and equipment or something like that, a 15.5% tax rate. Net operating losses used to be companies could carry net operating losses back 2 years and forward up to 20 years to offset taxable income in other years. Now this did change a little bit because of the whole COVID thing. Now they are allowing companies to again take losses from like this tax year. They're going to allow them to carry them backward to offset income in other years. But they said, okay, you'd have to carry it forward, and you couldn't eliminate 100% of taxable income, only 80%. There is a deduction on how much interest expense a corporation can take. Only up to 30% of earnings before interest, taxes, depreciation, amortizations. That I'm not going to probably test you on most of this stuff in here, but I will test you. I would like you to know that the new corporate rate is 21%, not 30%. Corporations receiving dividends from other corporations, if they own 20% or more, they get to deduct 65% of those dividends received. So you don't have, not only double taxation, but triple and quadruple taxation when you have Corporation A own shares in Corporation B, which own shares in Corporation C, and when they all distribute their dividends, you can have the same dollar of income being taxed at 3 or 4 or 5 different levels. So they say, okay, a corporate investor who owns stock in another corporation can exclude 65% of dividend income as long as they own more than 20% and 50% if they own less. Section 179, you can directly expense up to $1 million in plant and equipment costs in a year rather than having to depreciate it over time. And then bonus depreciation. And then there was the 20% deduction on qualified business income for pass-through entities like sole proprietorships. Okay, so again, the only part of all that I would hold you responsible for is just knowing that the new corporate tax rate is 21%, used to be 35%. The other thing I'd like you to know is how to be able to compute an after-tax cost. So if I were to go to Word here and enter in a Word document, something like, okay, let's say I got this Word document and I enter in interest expense of, let's say, $100,000. Does that interest expense really cost me $100,000 on an after-tax basis? And the answer is no. The after-tax cost of interest expense is going to be that $100,000 times, and then you multiply it by 1 minus the tax rate. So if we assume a 21% tax rate, it's actually only going to cost us $79,000 after taxes. Why? Because it's going to save us, since interest is a tax deductible expense and the tax rate is 21%, we're going to save 21% of that 100,000 or $21,000 in taxes. So the after-tax cost is $79,000. Now note that, again, if you're trying to find the tax savings from a deductible expense, you'd multiply the expense by the tax rate itself. So the tax savings from interest is the 100,000 times the tax rate of 21%. So I'll just put times 0.21, which equals, of course, $21,000. So that's the tax savings from interest expense. Whoops, that should say. Okay. But the actual after-tax cost then is $79,000. So you multiply the cost itself times 1 minus. There. Now we've covered chapter 2. Any questions on that? Okay. All right. So any questions at all? Let's go to our grid view here. See, make it a little bigger so I'll make sure everybody, it looks like we got everybody, all 6 of you that have joined us. Okay. And like I said, I knew Michelle. All right. Okay, well, no questions then on anything we covered in chapter 2. Well, then let's do that homework assignment in class. In fact, we could do both homework assignments here. Okay, so let me minimize our pictures again. All right, now the first homework assignment was the financial analysis. So first of all, it says we want to go to sec.gov and click on HD, which is a ticker symbol for Home Depot. Look up the most recent 10K for the company. The 10K is basically the annual report that the company files with the SEC. It may not be identical to the annual report that they send to shareholders. Sometimes it is almost identical to the annual report sent to shareholders. With the one big difference being an annual report sent to shareholders will always have a letter from the CEO or chairman of the board to the shareholders. The 10K will never have that. And sometimes there's other differences too, but that's the one difference you'll always see between the annual report sent to shareholders and 10K filed. So let's go to the sec.gov. Now, first question for Home Depot. Look at the balance sheet the last 2 years. In light of the fact that Home Depot's been profitable each of the last 2 years, why is stockholders' equity going down? And then the next question we're going to do for Home Depot, looking at the statement of cash flows over the last 3 years, what's the relationship between operating cash flows and net income, and what seems to be the largest reason for that relationship? All right, so let me minimize this, and we'll go sec.gov. And then if you go to filings, you can go to company filing search. And if we put in the ticker symbol HD for Home Depot, hit search. Okay. And we got a lot of different filings, 11Ks, 10Qs, which are quarterly reports, 8Ks, which is anything of importance about a company, DEF 14A, which details proxy issues, you know, like pay, stuff like that. Okay, not seeing the 10K on the first page. So here we go. Here's the most recent 10K. This would be for the year ended. Well, let's see if it's for the year ended. Let's go to the statement first. Actually, I think they end their year January 30th. And this is for the fiscal year ended, well, end of January, February 3rd, 2019. We should only have one yet for 2020. Just go back a second, go back and see, and go back another link. Let's just check one more time at first page and see, do we have a more recent one? Did I miss it? Oh, I did miss it. Okay, I was going to say we should have one more recent than that. Here it is. Okay. So this one. Okay, so here's the 10K for Home Depot. Oh, by the way, notice the par value for Home Depot stock, 5 cents a share. Remember we talked about how par value is pretty much meaningless and companies would always make it really low anyhow. So there you see it right there, 5 cents a share. Now, let's go to the financial statements and answer the questions. So first of all, if we go directly to the financial statements, okay, we got the report of the independent auditor. Okay, and then here is the balance sheet. Now, the first question said, in light of the fact that they've had profits, and we know that profits increase retained earnings, of course, dividends decrease retained earnings. But let's scroll down and let me skip to the income statement first. Here's our consolidated statement of earnings. So net income, earnings after tax for fiscal year 2019, which ended at the end of January 2020. When I say the end of January, it may not be January 31st. It'll be typically, it'll be the Friday closest to January 31st. Sometimes it'll be Friday in January. Sometimes it'll be a Friday in February, whichever one is closer to January 31st. Okay, so here's the net income. Realize, by the way, these numbers, as it says here, are in millions. That's they had net income of $11,242,000,000 for 2019. So that's a lot of net income. Now, if we go up here, scroll up, what happened to stockholders' equity? Which is right here. Stockholders' equity did not go up because realize that's a negative figure. They actually have negative stockholders' equity, and it went down because it got from the previous year because it got more negative. Went from a negative 1.87 to a negative $3.1 billion in stockholders' equity. So if you look at there, and we see, well, it's not that the common stock account, which would be stated at par value, that didn't change. Of course, the paid-in capital in excess of par went up. So that wouldn't explain the decrease in stockholders' equity. And because the earnings exceeded dividends, retained earnings went up as well. Now, we did have an other accumulated other comprehensive loss, but that's kind of a minimal change from the year before, so it's not explaining much. So what is the reason that stockholders' equity actually declined for the fiscal year 2019? You guys tell me. If you look at that, I'm just looking at you so I can ask the question. But let's, I'll minimize this again so you can see it. Whoop, there we go. So here's our stockholder equity accounts. This was the previous year. This was 2000. The year ended February 3rd, 2019. This is the year ended February 2nd, 2020. And looking at, the question was, given that they had income for the year ended February 2nd, 2020, why did stockholders' equity go down? And again, we're saying, well, common stock account didn't go down. Paid-in capital and excess part actually went up. And retained earnings went up. And then ignore other accumulated other comprehensive loss because the change is minimal. Why then?
The treasury stock.
Exactly. It's the treasury stock. Langdon, was that you, Tom? Or Langdon or Tom?
Tom, yeah.
Oh, Tom. Okay. Yeah. Tom. Yeah.
Apparently they took on a whole lot of extra treasury stock during the course of the year.
Exactly. They bought back. They have been buying back stock at a torrid pace. So treasury stock, remember, is stock that has been repurchased by the company. It's never been officially retired, so it still sits as treasury stock, but that's a contra equity account. That's a negative figure under stockholders' equity. That's the reason that total stockholders' equity ends up being negative, and even more negative than it was the previous year because they bought back more stock than had previously been bought back. So the treasury stock count was at 58 billion. Now it's over 65 billion. And that's the reason that stockholders' equity actually went down. Oops, I see we got Kelly trying to get in. Okay. So that's your answer to the first question. Why did stockholders' equity go down? Because they increased their purchase of treasuries. They bought back a bunch of shares in the most recent year. Okay. Now, the other question asked about the relationship between operating cash flows and net income for Home Depot. So now let's scroll down to statement of cash flows. There's that statement of comprehensive income, which kind of gets ignored. Okay, statement of stockholders' equity, not totally ignored, but certainly not paid as much attention to as other things. Okay, so here is net income for fiscal year 2017, 18, and 19. All right, each of those last 3 years. And then after all the adjustments, and notice they're making the same adjustments we've talked about, add back in depreciation and amortization, and then they're making other adjustments for current assets, current liabilities, etc. They also stock-based compensation expense. One of the expenses they showed is because that's one we did not talk about on the statement of cash flows, but basically they give like stock or stock options to management to compensate them. They don't actually pay them any cash. They just issue shares of stock to them. And in fact, in the case of stock options, management has to pay to acquire the stock. So the company doesn't pay out any cash for that expense. They'll have to show them. Same thing with an impairment loss. There must have been an impairment of goodwill. Now, we don't have one for the last year or 2 years ago, but we did have an impairment loss in 2018. That's a non-cash. That's a write-down of an asset like goodwill. It's a non-cash expense, but it still would have gone on the income. Those are being adjusted. And then everything else is pretty much all the same stuff we've talked about in class. So notice your operating cash flows, 12 billion versus net income of 8.6, 13 billion versus net income of 11.1, 13.7 billion versus net income of 11.2 billion. So each year, what do you notice about operating cash flows relative to net income? What do we notice? Kelly, what do you notice? I know you joined us late here, but what do you notice, Kelly, about operating cash flows relative to net income? So again, here's the operating cash flows each of the last 3 years. Here's the net income each of the last 3 years. And so what you notice, nothing happened there. Everything got bigger all of us. Trying to just pull it up here so we can see, Kelly. There you are, Kelly. What is the relationship between operating cash flows and net income?
It's costing more to run it than they're bringing in.
No, I wouldn't say that. Their operating cash flows are actually higher than net income. That's the relationship. Now, the question also asked, is that, do we think, or I think it may have asked, is that typical or like that? Or why? That's what it was. It was why. Okay, so let's go to why. So here, minimize that. So if we look, what is the biggest positive adjustment to net income in each of those 3 years? Anybody?
Well, deferred income or deferred revenue jumped way up in the most recent year.
Yeah, but that's 334. There's a lot bigger positive number than that.
Depreciation and amortization.
Right, yeah, depreciation and amortization. That's the biggest positive number each one of those 3 years. And remember, that's what we said. We said that typically, now it's not always going to be the case, but typically operating cash flows will be higher than net income. Why? Because of the add back of depreciation expense. Everything else on there, we see, well, there's some negatives, there's some positives, but you always got that add back of depreciation expense. Okay, so that answers your first 2 questions there. Why was stockholders' equity going down? Because of the repurchase of stock by the company. And the relationship between operating cash flows and net income is operating cash flows exceed net income. Why? Because of the add back of depreciation expense. That's the largest reason that operating cash flows exceed net income. So any questions on those 2 questions for Home Depot? Okay, well, and if we scroll down, we got some questions on Starbucks. Now for Starbucks, we don't want to look at the most recent 10K. I want you to go back to the 10K for 2014 and see, why did net income go down so much in 2013? And then why were operating cash flows so much lower than net income for Starbucks in 2014? Why did net income drop in 13? Why did operating cash flows drop in 14? And we're going to look at the 2014 10K for this. So again, we're at the SEC site. So well, I can go backwards, or I could just close it and reopen it. SEC.gov. And we're looking for Starbucks. We go to filings, company filing search. Ticker symbol is SBUCKS. Okay, and remember, it's not the most recent 10K, it's a 2014 10K. So we can put 10K there, or is it going to be 10-K maybe? Yeah. Prior to, let's just put 2015, and then month. Okay, let's oh 04. Oh. Okay, here's the 10K. Filing date, November 14th. Now, they don't end their fiscal year the same time as Home Depot does. So this is the one for 2014. We'll click on it. Here. By the way, notice the par value of Starbucks stock, $0.001 per share. So Starbucks has a par value of 1/10 of a penny per share. And remember, Home Depot had a par value of 5 cents a share. Yet Home Depot, I think, is trading in the hundreds of dollars. Here, if we we'll do just a quick check. Let's just go to finance stuff. Check on Home Depot. Okay. All right. We're going to check Home Depot here. Look at that. Home Depot was trading at close today at $250.31 a share, yet its par value is 5 cents a share. Starbucks, on them real quick. Starbucks closed today at $75.49 a share. And again, its par value is 1/10 of a penny per share. 1/10 of a penny per share. Okay, back to the 10K now. All right, so we're going to go down to the financials. So again, I'll click on financial statements. Here is the income statement. Now we said, so we have the income statement for the year ended the end of September 2014, 2013, and 2012. And I said, what caused the big drop in net income? And if you look at net income attributable to Starbucks from 2012 to 2013, we see a gigantic decrease in net income. So, of course, what we want to do is figure out, well, it's way lower in 2013 than it was in 2012 or 2014. Why was it so low in 2013? Is it because sales were bad? Well, if you look at the top line up here for company-operated stores, licensed stores. I'm sorry?
Is that the litigation? Was it litigation?
Exactly. Yeah, it's the litigation charge. Yeah, because the revenues, if you look, total net revenues are actually higher in 2013 than they were in 2012. But notice, right here, there was no subtraction of a litigation charge in 2012, and there was actually an adjustment to decrease it in 2014 slightly. But in 2013, they had a litigation charge of $2.78 billion. Again, these are in millions. So that's $2.78 billion litigation charge they incurred in 2013. Now, why did they incur that charge? Well, actually, if you go to the notes to the financial statements, the notes explain that they had an agreement with Kraft Foods. This was when Starbucks first started getting their coffee into grocery stores for like the, what do you call the coffee makers, the Keurigs and stuff. So anyhow, when Starbucks first started going into the grocery stores, they're like, okay, Kraft already has a relationship with the grocery stores. We'll partner with them and let them introduce our products to grocery stores. So they entered into a contract. And then they weren't satisfied with the way Kraft was performing, so they terminated the contract, and Kraft sued them, and they ended up, I think it was actually a settlement where Starbucks agreed to pay Kraft like to over, about $2.78 billion. Okay. And that's the answer to the first question there. And why did income, you can't see it very well. Okay, why did net income decrease so drastically in 2013? Because of the litigation charge in 2013. So the next question, well then why were operating cash flows so much lower than net income for Starbucks the next year in 2014? And what we see, so if we go to the statement of cash flows, here it is, statement of cash flows. And here's our operating activities. Here's operating cash flows. Operating cash flows are 1.75 billion in 2012. If I go up there, over 2.9 billion in 2013, but then they dropped all the way down to 607 million in 2014. Why was that? I think it jumps out at you like a sore thumb.
That same litigation.
Again, yeah, they incurred the charge back in 2013, but notice it got added back in to net income just like depreciation did back in 2013. Why? Because they didn't pay for it in 2013. It actually got paid. They took a liability, incurred a liability, and said, okay, they like would have debited litigation charge expense for 2.78 billion in 2013 and credited accrued litigation charge payable in 2013. Then they actually paid it down here in 2014. They paid the accrued litigation charge. And notice they paid about 20 million less than what they had originally taken as a charge. That was why there was a $20 million adjustment net income in for some reason, the charge ended up being slightly less than they had accounted for. So that's your answer to those two questions. First, why did net income decrease so drastically for Starbucks in 2013? It's because of the litigation charge. And why were operating cash flows so much lower than net income in 2014? Same thing, the litigation charge. Otherwise, it's the same as, notice operating cash flows the other 2 years are higher than net income, as would normally be the case. Lower than net income in 2014, again, because of the payment of that litigation. So any questions on Starbucks? Okay, then Dollar Tree, and we're going to go to the 2016 10K for Dollar Tree. We want to know what caused sales to jump in 2016. We also want to know which assets jumped the most in 2016. And we want to know how the jump in assets was primarily financed. Of course, if assets go up, what else has to go up? Well, we know assets equal liabilities plus stockholders' equity. So if assets jumped a bunch, then either liabilities and or stockholders' equity also had to jump. Okay, so this is fiscal year 2016 for Dollar Tree. So again, what I'll do is I'll just close it and then reopen it. Rather than try to scroll back through everything. Yeah, see, gov, and filings, company filing search, and this one is Dollar Tree. DLTR. All right, and we're looking for 2016's 10K, so we're gonna put 10K, and we're gonna put prior to, let's make it like, I don't know, June 1st, 2017. Oh, right. Okay, so here would be, now this was, so I think this is the one for fiscal year 2018, even though it was, came out 2017. Oh, for the fiscal year ended, the end of January 2017, but again, that would probably be considered fiscal year 2000. Oh, by the way, what's the par value on Dollar Tree? One penny a share. 1 penny a share. Okay. Again, let's scroll down to find where the financial statements are. Financial statements right here. Start on page 45. We will scroll down. First question was, why did sales jump so much? Well, I guess the biggest jump was right here. From January 31st of 2015 to January 30th of 2016. That's almost double. Not quite, but almost double. And then we see another significant jump for the following year, ended January of 2017. Okay. Any idea what caused that jump? Well, there's two ways you can find that out. One of the ways is to look at the notes to the financial statements. Another way is to go into what is called the MDA, or Management Discussion and Analysis, or something similar to that. So there's the financial statements. Management Discussion and Analysis of Financial Conditions and Results of Operations. A lot of what's in here will also be in the notes to the financial statement. On that, okay, and we see item 8. Several key events have had or are expected to have a significant effect on our operations. In January 2015, they completed an expansion. This is the one right here. They bought Family Dollar stores. Okay. When did they actually buy it? Well, let's see, because they're going in chronological order here, I guess. Here it is. July 6, 2015, they completed the acquisition of Family Dollar. So, of course, from that point forward, for the rest of the year, from July 6, 2015 onward, all the sales of Family Dollar were also treated as sales of Dollar Tree. Okay. So remember, this is July 6, 2015. So if we go back to the financials, page 5 again, our income statement. Okay, so July 6th, it said 2015 or 16? I thought it was it 2015 or 16?
15.
15. Oh,
15.
Okay. So, oh, well, obviously then, yeah, 2015. So, in the year ended January 31st, 2015, none of that, this sales number here, that 8.6 billion, did not include any of Family Dollar's sales. But then by January 30th, 2016, they have about 6 months worth of sales, not only, well, of course, they have the full year of sales from Dollar Tree stores, but they also have about 6 months worth of sales from Dollar General. And then the next year, they've got all 12 months of sales from Dollar General, plus, of course, everything they would have had at Dollar Tree anyhow. So the reason sales went up so much was the acquisition of Dollar General. That's the answer to that first question, the acquisition of Dollar General in July of 2015. Now I'm calling that fiscal 2016. That was probably, it's for the year ended. I should probably say year ended January 16, because they may have called. Now, what particular asset balances jumped then in the year ended 2016? And how was that increase in assets financed? Well, let's go to the balance sheet and see. Here was the income statement. Here's our balance sheet. All right. So here's total assets from January 30th of 2000. Oh, you know what? Yeah, it's actually not showing on this one. I gotta go because they only show 2 years of balance sheet data. You know what? We gotta go back a year on the 10K. Sorry about that. I'm gonna go back a year. Instead of that one, we're gonna go to this one and open this one up. All right, now we'll go to the financial one for that one. And looking at the balance sheet here, Dollar Tree. If you look, well, a lot of assets went up. Inventory went up, you know, about 1.7 billion. You know, we had some other assets go up. You know, plant equipment went up. But the big increase is right here. That's almost a $5 billion increase. And right here, that's a $3.1 billion increase. What are those assets? Goodwill and trade name. So almost $5 billion of what they paid for Dollar General was for goodwill, and another 3.1 billion of what they paid for Dollar General was for the use of the name Dollar General. So the biggest, most of what they purchased were not physical assets. Yeah, I mean, they did get some. We do see an increase in plant and equipment of almost 2 billion. We see again about a $1.8 billion increase in inventory. So they did get some physical assets, but the biggest assets to increase were intangible, goodwill and trade name. So that's your answer to question 2. What assets went up the most? Goodwill and trade name, both intangible assets. The last question, how did they finance that increase in assets? Well, it has to be down here under liabilities and stockholders' equity. So which of those things went up the most from the previous year to the next year? Well, yeah, there was an increase in accounts payable and stuff, but here's a big one. Long-term debt went up, what, about $6.5 billion? Okay. We did have an increase of $1 billion and almost $1.6 billion in deferred tax liabilities, We did have an increase in additional paid-in capital and a slight increase in the common stock account. Why did that go up? Because they also, it was not a straight cash purchase. They also issued stock, although I guess even with issuing stock, some of it, or even if it had all been all cash, the equity still would have gone up because they didn't borrow everything that it cost. They borrowed a good chunk. Again, that's the biggest increase we see right there, is they financed most of the acquisition of Dollar General with long-term debt. So that answers the questions for Dollar Tree. What caused sales to jump so much? The acquisition of Dollar General. What asset balances jumped the most? Goodwill and trade name. And how was the increase in assets primarily financed? Well, primarily it was financed with an increase in long-term debt. And also, like I say, there was an issuance of stock that increased the equity too, but part of it. So that's the whole first assignment. Questions?
You want this emailed to you then?
Oh, there's a Dropbox for it, actually. So just write the answers, just like you can just download the sheet, write the answers right on the sheet if you want, and then just submit it to the Dropbox. Okay. And then because of time constraints, I'm not gonna do the, well, and it's part of chapter 4 anyhow, the forecasting assignment. I'll just give everybody automatic points on that. Okay, on the forecasting assignment. So it's still, Tom, did you do it already by chance, or?
No, I only did the one that was marked as due on the 24th.
Oh,
The one that we
okay,
just finished.
so the other homework assignment, and again, if I minimize this and this, you can see over here, one of the homework assignments was financial analysis questions. The other one was the forecasting assignment. If you go to the assessments tab and look at the Dropbox says, it should probably say, here's the one for the financial analysis assignment, which Tom has already submitted. Here's the one for the forecasting assignment. I said make it due July 1st. Again, I'm not actually, I'll just give everybody credit on that. I don't want to load you guys down too much because I was going to try to do that in class, and I know we don't have class time to cover. But any questions on the one we did cover, the financial analysis assignment? Look at you guys again. Let's see if you got any questions. Any questions? Doesn't appear to be. All right. Okay. Well, then let's move on to chapter 3. So I'll go with our thumbnail view here. Move over here, go to the book. Oops, actually, I may just move us over here instead and probably minimize it. Because what I want to do now is go to chapter 3. So that's going to be under here, part 3. Chapter 3 is on financial analysis. So you already did some financial analysis with this assignment in terms of, as you could see, looking at, looking at the financial statements, you were able to answer some questions just by looking at it. You know, well, gee, what Home Depot? Why is their stockholders' equity negative and getting more negative? Well, they were buying back a lot of stock. Why was operating cash flows higher than net income? Well, that's usually the case, and that's because of the add back and depreciation expense. You know, Starbucks, why was income so low the one year? Because of litigation charge, and then operating cash flows were low the next year because that's when they actually paid for the litigation charge. And Dollar Tree, why did sales jump? Because of the purchase of Dollar General, and most of what they bought were intangible assets like goodwill and trade name, and it was primarily financed with an increase in long-term debt. Okay, before we start chapter 3, I am the only one home, and as my wife was exiting, she said, the dog's outside. I hear the dog barking. I have to go get the dog right now. So take a couple minutes if you want to, and I'll be back down in just a minute here. And, yeah. Okay. Looks like some people are still away from their computers momentarily. Okay, so we're about halfway through class tonight. So the plan is we'll cover all of chapter 3 tonight. And then I think I told you we'll cover 4 and 5 next week and then the test after that, right? Is that about how we had said? Okay, good. Yeah. Okay. So, well, who else is? Kelly isn't quite, yeah. Tracy, you there?
I'm here.
Hmm. You are. Okay.
Sorry, it took me a minute to unmute myself.
Yeah, no problem. Yeah, we'll give Kelly, are you back or? Let's see her. Yeah, we'll give her another minute to come back. And then, like I say, we'll get started on chapter 3. Looks like we are going to have baseball this year, right? Looks like.
Yes, it would appear as of
Yeah.
today.
Unless the players really just say, no, we're not going to play. But yeah, I can't imagine they're going to give up a third of their salaries, now 37% or whatever. Yeah. All right. Well, we'll go ahead and get started here. So again, I'll minimize us, we'll move us over here. And so chapter 3 is on financial analysis. Like I say, you can look at the financial statements themselves and draw a lot of meaning out. And I like to look, as you can see in the 10Ks, you've got income statements and a statement of cash flows for the past 3 years, and you've got balance sheets for the past 2 years. So, you can look at things like, has sales been growing over time? What about net income? Has it been growing over time? Why or why not? In the case of Starbucks, we know why not, because of the litigation charge. Things like that. So you can look at the statements themselves, but you can also, there's other tools to evaluate the information in the financial statements that you can find helpful in analyzing a company as well. The tool that they particularly get into in chapter 3 on financial analysis is ratio analysis, computing financial ratios from the financial statement. Yeah. There is another tool that I want to mention that they don't really, I just want to make sure here, and I don't think they talked about it in the new edition either. Yeah, they did not show it in the new edition. But the other tool would be common size statement. Okay. So for example, there is what we call a common size income statement, and there's a common size balance sheet. The one I consider the most useful of those tools is the common size income statement. Why? Because what a common size income statement does is, instead of stating everything in dollar amounts on the income statement, it states everything as a percent of sales. Or sales is 100% of sales. And then cost of goods sold and each of your other various expenses are all reported as a percent of sales. So that way, you can see, are any of my costs or expenses going up as a percent of sales? If so, why is that happening? Or are any of my expenses going down as a percent of sales? And again, why is that happening? And we can determine that with common size income statement. Now, a common size balance sheet states everything as a percent of total assets. So of course, total assets are 100% of total assets. And then it would say, like, cash might be, for example, 3% of total assets, and plant and equipment might be 8% of total assets, so on and so forth. Okay. And then again, you can look over time to see, are things going up or down as a percent of assets, just like the common size income statement. Are your various expenses going up or down as a percent of sales? So that's the common size statements, common size income statement. Again, I do want you to at least know what it is. everything is stated as a percent of sales. Common size balance sheet, everything is stated as a percent of total assets. Okay, now let's look at the ratio analysis. Whoops, as a tool. Yeah, what is going on? Okay. Now, they list 13 ratios in the chapter. Again, each of those will be drive me nuts. But anyhow, so we're going to cover each of those. You do have the formulas for these ratios, of course, on the formula sheet, which obviously you're allowed to use for the test. You're allowed to use anything because the test is online. You'll be taking it at home. You can use the book, you can use your notes, you can use the formula sheet that I provided. You can use anything you want, but do realize there is a 3-hour time limit on the exam, so you still want to be prepared for it. I think some students, at least in the traditional age group, when we went to online, some of them got to thinking, well, it's an online test, it'll be easy, and they didn't prepare like they should have. So make sure you're prepared, even though, yeah, you're going to have all the tools you want available to you. You're never going to get through the test in 3 hours if you're trying to learn finance at the same time as taking the test on what you learned. There's just not time for it, even with a 3-hour time. That's the reason I do limit the time frame on it is, if I gave you 12 hours, well, people could find a way, figure things, but I want people to prepare ahead of time. So make sure you do prepare. Okay. So here's our 13 ratios, beginning with the profit margin. So if we scroll down, I guess I'll have to do it this way. Okay, here we have an income statement for the Saxton Company, and then below that, we have a balance sheet for Saxton. And then, and so we begin with the profitability ratio. First, the profit margin. They show you the formula, net income over sales, which, if we scroll back up now, net income was $200,000 for Saxton. Sales for Saxton was $4 million. So if you divide 200,000 by 4 million, that gives us 5% as the profit margin for Saxton. Now, one of the nice things with ratios is you can compare ratios of one company over time for that same company to see are the ratios getting better or worse, okay, over time. You can also compare them with the industry to see are they better or worse than the industry. How do we compare with the industry? Again, this is useful both for investors in the company, but also for corporate management in terms of if we're not doing as well as the industry on a ratio, what's the reason for it? And is there a change we may want to make? Okay, so getting back to the profit margin here, net income as a percent of sales is 5% for Saxton. But notice the industry average is 6.7%. Okay, so they don't have as high a profit margin as the rest of the industry. That could indicate a couple of different things. It could indicate that, oh, maybe they're not controlling their expenses as well as the industry. That might explain why net income is a lower percent of sales. Or it could be that maybe they sell at lower prices than the industry and try to make up for it on margin, which means their net income as a percent of sales isn't going to be as high, but they're going to generate more sales, for instance, per dollar of asset than the industry. In other words, they're going to have sell in higher quantities than the industry. A good example would be Walmart versus Target. Okay. Generally, and I don't know how it's been the last couple of years. I haven't looked at either company in a while, but I know, historically, Walmart has tended to have lower profit margins than Target, but they generate more volume of sales than Target. So then when you get to the next ratio, return on assets, they actually do better than Target, even though they have a lower profit margin. Okay, return on assets. And let me say a couple things here. One, not all of these ratios are defined or calculated the same way by everybody. Okay, so when you see this formula right here for return on assets, that's a pretty standard formula, but some sources, instead of, they're just using net income for the year divided by total assets at the end of the year. Some sources, when they have a ratio that has an income statement account and a balance sheet account, because net income comes from the income statement, total assets on the balance sheet. On the balance sheet account, they'll use the average. In other words, they'll take like beginning of the year assets plus the end of the year assets and divide by 2 to say, well, on average, what were the assets during the year and what was net income as a percent of those assets? Well, again, and that's likely the way your accounting book did it. But our finance book just uses year-end numbers for all the ratios. So that's what we're going to do. So return on assets, net income over total assets. Again, the net income comes from right here. Does anybody know how I can get rid of this annoying thing right here at the bottom? Anybody? I would like to just get rid of it. It's annoying.
I don't know. I have the Kindle version of the book, so it doesn't work the same way.
Okay. Yeah, now I thought, well, maybe if I mess with that. Now I got to go back in and find our place. All right. Sorry about this.
The only thing would be is if you hit that gear in the lower left, if it gives you some way to hide it.
Yeah, let's see. Settings.
Or try that little arrow in the right above the.
This one, I tried that
Try that.
one. Then when I click here, see, it just pops back up. When I try to scroll down the page like this, it pops back up. Yeah, I can get rid of it, but then I still can't use that button, but that's all right. I'll just, oops, and table of contents. That's worse, you know. All right. So again, return on assets, net income, which we have right here, 200,000. You divide that by total assets, which at the end of the year, the total assets were 1.6 million. So 200,000 over 1.6 million gives us a return on assets of 12.5%. That compares favorably with the industry average of 10%. So they're generating more income per dollar of asset than the industry. That's good. Now I want you to pay really close attention to this alternative formula for the return on assets. That's what we call a DuPont formula. Okay, DuPont, I don't know, somebody named DuPont figured out, hey, you can also compute the return on assets using this formula, taking net income over sales, or the profit margin, and then multiplying it by sales divided by total assets, which that's actually called the asset turnover ratio, and it does show up later on in the chapter. Okay, so in other words, your return on assets is partly a function of this profit margin, in Saxton's case of 5%. It's also partly a function of the asset turnover ratio. How much sales do you generate with your asset? So again, if we go back up here, sales and total assets. Well, total assets are 1.6 million. Sales were 4 million. 4 million divided by 1.6 million means our sales equal 2.5 times our assets. So that's what we call the asset turnover ratio. So your return on assets is partly a function of, all right, how many sales did we generate with those assets? And then it's a function of how much of those sales were then converted to income. All right. So notice then the reason that the return on assets is higher for Saxton than the industry, even though the industry had a higher profit margin or generated more income per dollar of sales, is because, yeah, but Saxton generates more sales per dollar of asset. They generate $2.50 in sales for each dollar of assets. And the industry only does $1.50. So again, that is a good indication to me that maybe Saxton just sells at lower prices and makes up for it by selling at higher volume. Again, think Walmart, Amazon, Costco, etc. Okay. Next is the return on equity, which is net income divided by stockholders' equity. Now, a lot of investors and a lot of managers may consider that the most important of your profitability ratios, because that's the return on the stockholders' money that's invested in the business, right? Okay, so if we go back up here again, net income was $200,000. Stockholders' equity on the balance sheet, well, they didn't give us total stockholders' equity. They just gave us a common stock account and a retained earnings account. Of course, we know there should have been a paid-in capital account, because common stock is supposed to be for the amount of par value stock. But anyhow, ignoring that the book took a ridiculous shortcut. If you add up the common stock account balance and the retained earnings balance, 400,000 and 600,000, total stockholders' equity is $1 million. So if you divide your net income of $200,000 by stockholders' equity of $1 million, that's a 20% return on equity, which is far better than the 15% return on equity for the industry. Now note, there's also a DuPont formula for the return on equity. You can actually derive the return on equity by using the return on assets and then dividing that by 1 minus your debt to asset ratio. Okay, so the return on total assets for Saxton was 12.5%. Now, what is that debt to asset ratio? If I scroll here, or okay, notice your total debt is 600,000. Total assets are 1.6 million. Well, if you have a calculator handy and you divide 600,000 by 1.6 million, you get 37.5%. That means that debt finances 37.5% of the assets of Saxton. So if debt finances 37.5% of the assets, then 1 minus that means that equity has to finance the other 62.5% of the assets. So when you divide the return on assets by the percent of assets financed with equity, 62.5%, that gives you the return on equity. Now notice the industry uses a little less debt relative to their assets. Their debt finances 33% of their assets. So 1 minus that tells you, okay, for the industry, 67% of the assets are financed with debt. Okay. Or I'm sorry, financed with equity. You take the return on assets divided by the percent of those assets financed with equity, that's your return on equity. So the way it works, actually using more debt can give you a higher return on equity. Right? Using more debt and thus less equity can give you a higher return on equity. I want to say that one more time. Using more debt and thus less equity can give you a higher return on equity. So one of the things that I personally and most analysts or investors will look at when they see that a company has a real high return on equity is they'll say, oh, well, does that company have a lot of debt? Because a lot of times for companies with a high return on equity, it's because most of their assets are financed with debt. So they just don't have very much equity that they're dividing their net income by. See? Does that make sense? So, questions on the, I don't know why it's not, there we go. Questions on those profitability ratios.
Can't that go sideways for them real fast if they?
Well, it can, because on the one hand, using more debt is going to give you more equity, or I'm sorry, less equity, but it's also going to give you less income, right? Because you got to pay interest expense on that debt. So on the one hand, using more debt is going to cost you more in interest expense, which is going to give you less net income. But because you're using more debt, you're also going to have less stockholders' equity that you're dividing that net income by. And so because of that, typically it's going to result in a higher return on equity. But yeah, that's a good point, Tom. Not always. Not always. Because what if you have a bad year? And let's say, put it this way, basically, if your EBIT, earnings before interest and tax, okay, is EBIT as relative to assets, that has to exceed your interest rate for you to end up with a higher return on equity. Well, generally, you would hope that my operating profit as a percent of assets is going to be more than my interest rate I'm paying on my debt. But again, if it's not, or if you have a bad year and it's not in that year, then actually the added interest expense is going to more than offset the fact that you have less equity and the return on equity. So one thing I like to tell students is while on the one we do like to use maybe, or it's probably not a bad idea, let's put it that way, to use a certain amount of debt financing in business. Why? Because debt is your cheapest form of financing. Remember, I think we mentioned this last time, or maybe that was my other class, can't remember. But we said, anyhow, the fact is bondholders, that's who holds your debt, they're not going to demand as high a rate of return as your stockholders. Why? Because they're not taking as big a risk. They're the first ones to get paid. Stockholders are the last ones in line to get paid. So since the stockholders are taking a bigger risk, they're also going to demand a higher return than your bond. Secondly, the interest you pay on debt is tax deductible. Dividends you pay to stockholders are not tax deductible. So that's the other reason then that debt is your cheapest form of financing. But because it's a legal obligation and has to be paid, or you're in default and could be forced into bankruptcy, then debt is also your most risky form of cheapest form of financing, but it's also your most risky form of financing. So you always kind of have to balance those two out. Now, some companies say, we don't care if it's our cheapest form of financing. We are not going to have any interest-bearing debt. And there are some companies that do not have, they'll have liabilities because, I mean, everybody's going to have a certain amount of either accrued expenses or accounts payable or deferred taxes or deferred revenue or something like that. I mean, so everybody's going to have a certain amount of liabilities, but not everybody borrows money. In other words, a lot of companies have no interest-bearing liability because they don't borrow any money. They say, yeah, I know it would be cheaper to borrow money to finance a company than issue stock, but I also know it's more risky. We're just not going to do it. Other companies, of course, some of the ones that went bankrupt here, filed for bankruptcy recently, Hertz Rent-A-Car, J.C. Penney's, et cetera. They had borrowed too much money. They had used too much of their cheapest form of financing and ended up bankrupt. Okay, next is what the book calls asset utilization ratio. Sometimes they're also referred to as efficiency ratio. They begin with the receivables turnover ratio, which is sales divided by accounts receivable. So again, if we go back up, sales on the income statement was $4 million. Then if you look down to the balance sheet, accounts receivable was $350,000. If you divide the sales by the accounts receivable, oops, you get 11.4 times versus an industry average of 10 times. Now that's good. Generally speaking, you want the receivables turnover ratio to be higher as opposed to lower. Why? Because the higher the receivables turnover ratio, the lower the average collection is the next ratio. Okay, so the average collection period is the accounts receivable balance divided by average daily credit sales. So the accounts receivable balance of $350,000, that came straight from the balance sheet. How did they get this average daily credit sales balance of $11,111? What they did was they took the $4 million of sales and divided it by the number of days in a year. And now this is where our book uses a 360-day year for the number of days in a year. We all know there's really 365 days in a year or 366 in a leap year, but the book still chooses to use a 360-day year. There are times in finance when we do use a 360-day year. For instance, when you compute accrued interest on a bond, for example, normally that's based on a 360-day year. But anyhow, so the book says, 30 days in a month, 12 months in a year, 360 days in a year. So that's how they get this. They took $4 million, and if you do that on your calculator, and divide 4 million, doing it now as I speak, divide that by 360, the number of days the book uses for a year, that's to the nearest dollar, that's exactly what you get in average daily credit sales. By the way, notice they assumed all sales were on credit. Assume the same thing in all of my examples and test questions. So that's so they're dividing the accounts receivable balance from the balance sheet of $350,000 by the average daily credit sales, which again, they took 4 million over 360 days in a year to get 11,111 days, and that gave them 32 days. I don't think that's exactly, I think they rounded a bit there. Just double checking that. Yeah, it's really 31 and a half days. They just rounded it to the nearest day and gave it. But that's still better than the industry who's taking 36 days to collect on their receivables. So again, you want a high receivables turnover ratio because the higher that ratio, the lower the average collection period. In other words, the sooner we collect on our receivables. So let me ask you guys, why is it important for us to collect sooner rather than later on our receivables? Why do we want to collect
Well,
sooner?
we might need the cash to operate with.
Okay, yeah, the sooner we collect on those receivables, the more cash we have freed up to operate with. Exactly. Yeah, the longer it takes us to collect, the less cash we have to work with, which means more money may have to be borrowed, or we have less money, less cash then to invest in short-term investments and so forth. So sooner we get our cash, the more cash we have available, which again could be used to maybe pay down some debt or to invest and earn some kind of return. And that's a good thing. So, and some people will also say, well, the sooner you get it, the more likely you are to get it. That's probably true also. The sooner you get your money, the more likely it is you're gonna get your money, right? Okay. So that was those two. Then inventory turnover. Now, this one, a lot of sources use sales, just like our book does, divided by inventory, or a lot of sources use average. But a lot of sources also use, instead of sales, cost of goods sold divided by inventory. And I would say, based on all the ratios I've looked at over the years and all the books and formulas I've looked at over the years, it's probably roughly 50-50. About half of them seem to use cost of goods sold as a numerator, half of them use sales. I don't think it's real important which one you use as long as you're consistent. So if I'm going to compare the inventory turnover ratio for Saxton by dividing sales by inventory, then I got to make sure I use the same formula for the industry. Otherwise, I'm not comparing apples to apples, right? So again, sales were 4 million, and notice, by the way, it does say all on credit, okay? And we're dividing that by inventory, which was 370,000 right there on the balance sheet. So 4 million over 370,000 gives us 10.8 times as an inventory turnover ratio versus 7 times for the industry. That's good. You want a higher inventory turnover ratio as opposed to a lower. Why? And I almost invariably get the same answer on that, but I'll see what I get. Why? What does it mean? Let me say it this way. What does it mean if the inventory turnover ratio is low? What's that telling the company?
You're not selling.
That's the answer I always get. That's the one I was saying. I almost always get the same answer. It's going to be you're not selling enough. But that's, and if we look at the numerator of the formula, let me minimize this again here for a second. If we look at the numerator of the formula, we'd say, well, yeah, if we had more sales, we certainly would have a higher inventory turnover ratio. But we can't, what do we have more direct control over, sales or inventory? I mean, we have some control over sales with our marketing efforts, et cetera, but don't we have more direct control over how much inventory we carry? In terms of how much, when we purchase inventory, what quantity we purchase in, things like that. So if we put the focus, take the focus off the numerator and instead put it on the denominator, inventory. Now, if I ask the same question again, what does it mean if your inventory turnover ratio is too low? And we don't use sales in the answer, what would you say?
Means you're sitting on too much inventory.
Exactly. Means the denominator is too big. You got too much inventory. Okay. Why is it bad for a company to carry too much inventory?
Because inventory is money that can't be used on other things.
Exactly. If you have excess inventory more than you need, that means you have excess cash tied up in that inventory that, again, you could either be using to pay down debt, or you could be using to invest in short-term investments and earning some kind of return on. But instead, it's tied up in excess inventory because you got more inventory than you need. The other thing is, of course, the more inventory you have, the more storage and handling costs you're going to have. The more inventory gets stolen a lot, whether it's customers or employees. So the more theft and the more, you have excess inventory, it's definitely more likely to get spoiled or become obsolete or get stolen. So you don't want to carry too much inventory. You have to carry enough, because if you don't have enough inventory to meet customer demands, what's customer going to do? Laura, what's the customer going to do? I could read your lips. He's going to go somewhere else. Yeah. For some reason, the mic didn't work. Yeah.
There we go. Sorry.
Perfect. Yeah, I can hear you now.
I have two microphone buttons, so
Oh,
they
okay.
they were both on mute. And
oh, gotcha. Because I saw the mute go off, and then I'm
Yeah.
like, oh, but I didn't hear you, but I could read your lips. And
I didn't realize that I had to hit both of them, though. Okay.
yeah. Well, learned something new today. So yeah, if you don't have enough inventory to satisfy, the demands of your customers, they'll go somewhere else to buy. So you have to carry enough, so that you're not constantly running out of goods. But at the same time, you don't want to carry so much that you've got excess inventory, excess cash, thus tied up in that inventory. On top of that, you then have, again, extra storage and handling costs you otherwise wouldn't have had. You've got more theft, spoilage and obsolescence costs, et cetera, et cetera. All right, let's look at the next one. Fixed asset turnover is sales over fixed assets. Again, we know sales was the 4 million right there from the income statement. What do they mean by fixed assets? That's your net plant and equipment. That's what they consider the fixed asset. So that's 800,000 here for Saxton. You take 4 million divided by 800,000. Where are we at? Okay. The fixed asset turnover ratio is 5 times. The industry average is 5.4 times. So certainly we would prefer a higher fixed asset turnover ratio as opposed to a lower one. Just like in the case of this one, we said, well, you know, the inventory turnover, if it's too low, it's because you got too much inventory. Same with fixed asset turnover. If it's too low, maybe you got too much in fixed assets. Although that, you know, so you have too much net plant and equipment. What are you going to do? You know, well, I guess you could sell off some of it if it doesn't affect your operations, but you're certainly not going to tear it down, right? So anyhow, and there could be other reasons that you have a lot of fixed assets. Maybe you're growing more rapidly than the industry, and because of that, you just went through an expansion of your fixed assets. Maybe you just expanded plant and equipment. You know how it is. You're not going to expand plant and equipment every single year. So when you do it every few years, you're going to do it, expand it enough that it's going to cover you for the next few years of growth, right? So it might be they just went through a major expansion of plant and equipment. Could be they're more automated than the industry. Maybe they've got a lot of expensive technology and robotics in their manufacturing process, more so than the rest of the industry is using, which gives them more fixed assets, but maybe it saves them on labor costs, you know. I personally don't consider the fixed asset turnover to be real important. It tells you something. The next one is much more important. Total asset turnover, which is sales divided by total assets. So again, you know, there's your sales, 4 million. You go down to the balance sheet, there's total assets or net assets, same as total assets. 1.6 million. So 4 million, 4 million divided by 1.6 million gives you a total asset turnover ratio for Saxon of 2.5 times versus an industry average of 1.5 times. So that's good. In fact, that's great. Because remember, this ratio also had a direct impact on one of your profitability ratios. Remember which profitability ratio had a DuPont formula that used total asset turnover, sales over total assets? Anyone? It was the return on asset.
Yeah.
Yeah, go back up here. Return on assets could be found by taking sales over total assets, the total asset turnover ratio, times the profit margin, net income over sales. We said, well, gee, Saxon had a lower profit margin than the industry, 5% versus 6.7%. But they still generated a higher return on assets. Why? Because they sold with a lot higher volume relative to their assets. They had a much higher asset turnover ratio than the industry. That's a very important ratio. Okay, so that's it for the asset utilization ratios. Any questions on those before we move to the next set? Ooh, almost 7:20. We'll try to move quickly here on the next rest of them, which actually, okay, next is what we call liquidity ratios. What do we mean by liquidity ratios? Well, what we're measuring is how liquid is the company. What do we mean by how liquid is the company? What is their ability to pay their short-term debts as they come due? So one of the ratios used to measure liquidity is the current ratio, which is simply current assets divided by current liabilities. Now remember, current assets is cash and those other near cash assets that will either be converted to cash or used up in a short time. Current liabilities, remember, are those debts coming due in the next year. So if we go back up in the case of Saxon, it's 800,000 over 300,000 or 2.67 times. Go back up to the balance sheet. Total current assets, which consisted of cash, marketable securities, accounts receivable, and inventory, is 800,000. Current liabilities, those debts coming due in the next year, total 300,000. So 800,000 divided by 300,000 gives us a current ratio for Saxon of 2.67 times versus an industry average of 2.1 times. So we'd say, well, that's good. That's good. All right. Now, there's another liquidity ratio called the quick ratio, which you can see is very similar to the current ratio. The only difference is in the numerator, they take current assets and then subtract out inventory and divide that by current liability. Now, why subtract inventory from your current assets? Well, again, if we look back at these current assets, which of these current assets, okay, cash, marketable securities, accounts receivable, and inventory, which of those current assets who are most readily available to pay our short-term debts as they come due? Cash, marketable securities, and accounts receivable, right? Which one is the least, is going to take the longest to convert to cash? Inventory. Inventory is going to take the, of your current major current assets here, inventory will take the longest to be converted to cash because it has to be sold first, and that may take a month or two. Then typically becomes accounts receivable because, you know, especially in the case of Saxon, all sales were credit sales. So it goes into accounts receivable before it eventually is cash that you can use to pay down those short-term debts as they come due. So of the major current assets, inventory is the least liquid. Because of that, it gets subtracted from current assets in the numerator, the quick ratio. So for Saxton, when you subtract the inventory from the current assets, again, inventory was 370,000. You take 800,000 in current assets minus inventory of 370,000, that leaves you with 430,000 of very liquid assets. Divide those by, again, the current liabilities, which we already saw were 300,000. And we have enough very liquid current assets to cover those current liabilities 1.43 times. The industry average for the quick ratio is only 1 times. So we can see that, we being Saxton, appear to have better liquidity than the industry. So that's good. Because, of course, if you can't pay your short-term debts when they come due, what happens? You go into default and then you're bankrupt. So we don't want that. We don't want a liquidity problem. Finally, we got 3 more ratios. Our book calls them debt utilization ratios. Some sources call them leverage ratios. Same thing. Beginning with total debt to total assets. In other words, simply divide the total liabilities by the total assets. And again, when we went to the balance sheet here, we saw that total liabilities were 600,000 for Saxton, total assets 1.6 million. So that gave them a debt to total asset ratio of 37.5%, which is a little higher than the industry average of 33%. Now, again, what did we say about you know, using debt? That on the one hand, the benefit of using debt is what?
Cheapest cost.
the cheapest, exactly, Tyrone, cheapest form of financing. On the other hand, though, it's also your most. I
Risky.
think I saw Kelly mouth it down there. Whoop. Kelly, did you say it?
Sorry.
Yes, you did. Okay, you were muted. That's all right. Yeah, most risky. So, so we see that Saxton has a higher debt to total asset ratio. Where'd we go? Saxton has a slightly higher debt to asset ratio than the industry. Probably not enough to really concern us. 37.5% versus 33%. But again, the more debt you use, the more risky you become. Now remember, this ratio was also used in one of our profitability ratios. Which profitability ratio used the debt to total assets? Remember?
Is that in the stockholder equity ratio?
Yeah, exactly. Return on equity. Yeah, we go back up here. Return on equity can be found by taking the return on assets and dividing by 1 minus the debt to asset ratio. So the larger the debt to asset ratio, the smaller 1 minus that is. The smaller your denominator, the higher your quotient. Okay. So I know that's so having a high debt to total assets or higher debt to total assets means 1 minus that, or the percent of assets financed with equity, is smaller. Having a smaller percent of assets financed with equity results in a larger return on equity if we hold the return on assets constant. Of course, as Tom kind of pointed out, yeah, but the return on assets might not actually be that high if we had more debt and thus more interest. Anyhow. Okay, so that's the debt to asset ratio. Next is the times interest earned, which you see as earnings before interest and taxes divided by interest expense. So if we go back up to the income statement, EBIT, that's the same thing, remember, as operating profit, as $550,000. Interest expense is $50,000. So 550,000 divided by 50,000 gives us a times interest earned ratio of 11 times versus an industry average of 7 times. So we might, even if we were concerned previously that our total debt to total asset ratio was slightly higher than the industry, this should help alleviate that concern somewhat, because we are better able to cover our interest expense with operating profit than the industry. Why? How can we finance a larger portion of our assets with debt than the industry, but still cover the interest expense on that debt better than the industry? There could be multiple reasons. It might be that more of our debt, ours being Saxton, maybe more of our debt is non-interest bearing, so less of our debt actually has interest expense. We go back to the balance sheet here and look at our liabilities. Accounts payable doesn't have any interest expense. Notes payable does, so does long-term debt. So it's probably not that, because the vast majority of our debt is interest bearing. It could be that maybe we have a lower interest rate on our debt than the rest of the industry. It could be that maybe if we took EBIT, earnings before interest and taxes, as a percent of sales, that's called an operating profit margin. I wish our book had included that with our ratios, but it didn't. Anyhow, maybe the operating profit margin is higher to begin with. We know the net margin was lower than the industry, but perhaps the operating margin was higher than And that's why they get, or it might just be, this is a textbook example and it usually doesn't happen that way. Okay. All right. Lastly, the last of our ratios, fixed charge coverage, which is earnings before fixed charges and taxes divided by fixed. Well, interest expense is one of those fixed charges. But one of the ways that companies sometimes may incur fixed charges other than interest expense is instead of borrowing money to buy an asset, they might lease an asset. Well, if you lease an asset, that's still a legal obligation, right? That lease contract is a legal binding contract. As lease payments have to be paid, or you're in default on the contract, and they can come in and take your assets and so forth. So again, lease payments are every bit as much a fixed cost as interest expense. So if we go back up here, how did they get earnings before fixed charges and taxes of 600,000? How did they get fixed charges of 100,000? Back up to the income statement. Notice there was a footnote for selling an administrative expense, and down here, with regard to that footnote, it says that included $50,000 in lease payments. So to get earnings before fixed charges and taxes, they took earnings before interest and taxes, in other words, your operating profit of $550,000, and added back in the $50,000 in lease payments that were previously subtracted in getting operating. So that's how they get the $600,000 for earnings before fixed charges and taxes. They then divide that by total fixed charges, which includes the $50,000 of interest expense plus the $50,000 of lease expense for a total of $100,000. So 600 over 100 gives them a fixed charge coverage ratio of 6 times. While that is quite a bit lower than the times interest earned ratio, because the lease expense is just as high as our interest expense, it's still better than the industry average on the fixed charge. So all in all, I think we would have to evaluate this company, Saxton here, as pretty good. Almost all of the ratios are better than the industry. Again, they were below the industry average on a profit margin, but that could just be because of lower prices. They were below average on fixed asset turnover, but again, maybe they just went through an expansion or you know, maybe automated in their factory. They had slightly more debt, but they're still have better liquidity ratios, and they're covering both the interest expense and fixed charges better than the industry. All in all, I think we like this company quite a bit. That's as much as I'm covering of this. So, questions? On
I have a
Who was that?
Laura.
Go right
I
ahead.
have a question on the formula sheet.
Uh-huh.
The DuPont formula for return on equity. You have it as return on asset times leverage ratio, which is different than what you showed.
I'm sorry. Yeah, let me fix that. I'm going to make a note to myself. I will fix that. Fix the DuPont on the return on equity. Okay. Yeah. The one I show still works, but the leverage ratio is total assets over stockholders' equity. And if you multiply that by the return on assets, it will give you the exact same result as doing it the other way. But
Okay.
I want to alleviate confusion by sticking to the same formulas as the book uses. So I will change that. Thank you, Laura.
You're welcome.
Did anybody catch any others that maybe I did something different on the formula sheet versus what, Jed? No? Okay. Any other questions, comments? All right. Well, again, got a lot done. Next week, we do cover 2 chapters, but don't take as long to cover. 4 and 5. And then the test will be Wednesday and Thursday of next week. Which, well, let's see, Friday's the 3rd, right? So that's right before the 4th of July. You'll get test 1 out of the way anyhow. And then, yeah, and like I say, turn in the assignment we did tonight in the Dropbox for the financial analysis assignment. The forecasting assignment, forget about it, don't do it. Well, do it for your own sake if you want to. It might be fun for you to look up what you were asked to do, but you don't have to turn it in. I'll just give everybody automatic. Again, I felt like I needed class time to cover that assignment. We just simply don't have it. Anything else? All right, guys, have a great week. Thanks for being here. Take
too.
care.
Bye.
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 What? How does it do that?